Hey, coach, we can't hear you. You may be muted.
How about now? Yeah, I must have been muted.
Yes, yes, we can hear you
Okay.
now.
So, how did everyone like my pantomime? Did you know I was a mime?
That was a good one.
Anyway, what I was saying is I thought I'd say hello to all our viewers at investing.com, and my sticky note didn't work for Venkata, but we start at the top of the hour for future reference. So everyone, how are you doing? Hope everyone did okay with the Fed. It was pretty much a non-event, right? So a couple of things that I see that could develop, a couple of divergences that are fairly new, and so I'd start with the dollar. And here's drive one, here's drive two, and this is the 1 hour TF. And since we've come off like this, if I get one more rally to new highs, could have a three drive. So people are saying, and I have to hold myself back. Well, Dale, if you think there's going to be a third drive, why don't you just buy it here and ride it up here? Because there have been many times I haven't gotten the third drive that I was looking for. So trades that you're looking for doesn't mean it's going to manifest. But if it does manifest, you know what you're ready to do. So it looks pretty similar on the 4 hour time frame as well. You see right here, you had a confirmed high, and then the high we made a day or so ago was under 70. And if we get one more, the RSI reading was under 70. So we get one more. I'm going to top pick the dollar. It's come quite a long ways, and DSI is up to 70 or so. And this could be it. And I'm not saying that the dollar is going to collapse, but we've had a pretty nice run up here for, from here to here. So from a trading perspective, 97.5 is going to be an initial target should we get up there. So it's pretty analogous. I know everyone wants to talk about the pound. I'm going to hold that off for Estelle. And actually, we got the reaction we thought we would get if there was no move on interest rates by in Carney's swan song. So the euro actually, has a little different look to it because you see this RSI right here on the 1 hour. So there was no divergence between this low, see this? Volume's low, okay. And see this low right here? Everything's low, volume's low, and this low right here. Okay, let's see if I could do something here with the volume. So I'm trying to basically make the point that there could be one more low in the euro, and I would go for it there, okay? So on the 4 hour, you have it diverging. This may have been it. Maybe we're going to come out of the hole, but I think there could be one more decline in here. And then we get some type of decent correction in euro as well. Something else that's going on is we have this, the break that we had in yields, and we're talking about lower yields. So for the first time in a while, I'm starting to get a little divergence in TLT. I still think TLT is on its way to new highs, but I am beginning to get a little divergence there. 1 hour, see, it's pretty glaring. And then you go to 10-year yields. Okay, so look, we're at new lows, but this might be drive two. And if you've been following Face webinars for a while, you know that I don't think this thing is complete until we make a new low. So, but we are, these kind of divergences may not be enough for you to fade a market and take the other side of a trade, but it is a good reason for taking profits. If you've been long for this breakout in TLT, you've caught a very nice move. And if you were long notes, if you're long any any interest rate market. Again, breakdown, but again, getting a little overdone. In fact, the 30-year actually looks a little better than the 10. Look at this, and then look at this, which kind of tells me when this is over, this last decline to new lows under 145 on the 10-year note, that we could probably look for steepening of the curve. I think this is the last time the curve will try and come in. I don't know if it'll invert. It depends what you compare 2s to 10s, etc. But it's saying that after this final decline, and I am, after this completes down here, looking for what might be, I know just like people have tried to topic the S&Ps, people have been trying to call the end of the bond bull market for, I don't know, about 20 years. But I do think that there's a chance after this is done. Here's TLT. After we make some new highs here, new historic highs, that this could be it in bonds. Okay, so here's a reason why I thought the bonds could make new highs. When you look at the weekly, see that momentum? You only seen half my face on. Let me take the other half off. It's because I'm staring down. It was nice seeing everyone. So you see this RSI right here? I mean, markets don't top. They can put in a top, which what it did, but not the top with this kind of momentum before a correction. So with that being said, Blake, how's the Fed for you? It looked like it was pretty much a non-event.
Yeah. Hold on really
Yeah.
quick. I
Sure,
just
bro. Look at those.
just took a position, so I'm just writing it down.
Triangle.
So hold on one second.
Sure. And I do think that one of the better groups to buy once you think yields have bottomed would be the banks, especially if we're going to steepen. So I'm going to be pretty interested in seeing during this
Um,
correction. Go ahead, Blake.
okay. Sorry. I just
Okay.
had to write that down. So so how you doing today?
Good, bro. No
I
headache.
got up a little early this morning, but okay, so I guess let me see here. I pull over the charts. The FOMC was good. I was short dollar yen. I was short actually dollar yen and
Nice.
dollar Swiss overnight.
Yeah.
So that was good. The Swissy, if this was pretty key here in the dollar Swiss. So let me show you what I did here. The reversal after hitting new highs and hitting the 38% retracement right here
Yeah.
triggered
And,
me short. So I got
and
short.
just enough to take the stops off
Yeah,
where you
yeah,
anchored it.
exactly. And
Yeah. I love those.
Benedict
Arnold?
BW in our chat
Oh,
room, he brought it to my attention. I'm like, and I was kind of focused on the dollar yen. I'm like, yeah,
the
that
edge
looks
of
like
a community.
yeah, that's the important part of what we do. It's like he brought it to my attention and he's like, yeah, I got short some dollar Swiss. I looked at it, I'm like, you know what? I want to be short some dollar Swiss coming out of this triangle. I saw it hit the 38% retracement, saw the false breakout, and I'm like, yeah, I want to be short as well. So I shorted some last night at 42, and I just closed it at the figure. So it was like 97. Oh, well, it was like 97.05 or something like that. But and then I was short the dollar yen, because of the uh, gap
That's it.
fill reversal, and I'm like, okay, I'll take that position, and I shorted that. So here we are at support now, or here we are down at these levels, and I closed mine at 108.90 last night, so about 12 pips higher than where it is because I just took it off so I could sleep. The thing is we are at pretty key support, and I tweeted about this on the S&P, and I'm gonna just extend that out a little bit. we are really what I figure at some very key levels of support here for the market. Um, can we break down from here? Yes, we can. Um, you know, I'm a little skeptical about trying to play the short side ahead of the weekend. It's it's not only month end, but we're dealing with the reason why the stock market is down is the virus, right?
Yeah.
So I guess the risk is, it's twofold. How about if things get better, or how about if things get worse? I would assume the eternal optimists in human beings and people in general are going to say, it is the reason why the coronavirus has spread so quickly is because of, all the travel over Lunar New Year, and it stoked a lot of, easier to spread around over the week or the last 2 weeks because of that. But it's eventually going to peak and follow a similar pattern than that SARS did, and eventually, um, you know, uh, get a little better, get a little better moving forward. So I think that's probably the stance the market's going to take going into this weekend. Whether it's today or tomorrow, I'm not sure. But for me, in order for me and by the way, I was short equities for the last week and a half or whatever, and I just closed it this morning. So, and I closed it really right on this trend line, at like 48 or so, 49. So I closed it knowing that we're on this support, and really I want to be short on a break below these lows, but that probably won't be until tomorrow, or excuse me, until next week.
Nice cutout, Blake.
Well,
you know what I mean.
Yeah, but what I want to see in order for me to be um, short equities moving forward is, this coronavirus is indeed worsening. I hope it doesn't. I really don't. I hope the market
I was
falls.
talking about that you didn't have immediate gratification on the trade and you gutted it out.
What's that?
That you didn't have immediate gratification on the trade. You had to take some heat. And I'm assuming it's because you didn't have a lot of leverage. It was easier to keep taking home a position that wasn't working for a few days.
Yeah.
That's what
It
I'm
was,
saying.
and
Yeah.
so I'm for me, like I said, for me to reestablish a position now is going to be, I have to see a clean break, and I want to know that the coronavirus is getting worse and not better over the weekend, and then that might, that would take us probably towards this 3150, maybe even back down towards 3100. But right now, I'm a little skeptical, trying to be too short at where we're currently at. That's not saying that we can't break down. That's not saying that at all. But that's kind of what I'm looking at for right now. A couple observations I want to bring. So with the cable, we've rallied off of this support. Now, this played just like we had talked about the last couple of days. I did wuss out of the cable. I sold mine at 130.32 this morning, because I'm like, God, I'm profitable. I'm just gonna. It wasn't quite at 130.50 where I wanted it to be, but I took it off, took some profits, and then once I heard they didn't cut, I scalped in and out of it for 20 pips higher. I got in and out like at 55, got out at 75, and that was it. So the it's I didn't capture all of this upside, but that's okay. I feel good about what I did, and I feel, wow, the cable is just squeezing right now. It's squeezing past 131. Now, one of the other things, Carney is speaking right now, so I hear him muffled. I just don't know exactly what he's saying at this moment. But the cable is taking stops above 131, and my assumption is we're going to squeeze towards 131.30 or 40, which I think we're building like this triangle formation. So I think that's what we're doing currently. So just, just keep that in mind. Hold on one second here.
It's funny. The pound rallied just as Carney said. He has no regrets about the monetary policy during his tenure.
Really?
make whatever you want out of that. I have no idea.
What is that? Yeah, what is that supposed to mean? Is that why the pound squeezed? I think that
I
the
don't
pound
think
was
so.
probably
No.
just looking for reasons to squeeze
Yeah,
higher
yeah,
anyway.
Yeah.
Right.
But it's a lot of people have criticized him over the last years, right? About his being the unreliable boyfriend. That's his nickname.
The unreliable boyfriend
Yeah.
is definitely his moniker here. So let's look at this range, and if
any chance that he just said that now that I'm leaving, I don't care what the pound does?
I don't know. Did he?
yeah, I have no idea. I can't with I had to turn down the volume. I have his press conference on right now, but I had to turn down the volume, so I missed any of the most recent comments. But look, this range, we're almost at a 261% extension. So my assumption is the cable's probably intraday going to stall up here. Probably right through here, somewhere around here, and we'll pull back and consolidate, but I wouldn't want to be short the cable. I don't think. I still think that the pound is a currency that you want to be long. I just intraday, I don't know if I'd really want to be long at current prices, right? So, but now, so the cable is stronger. Stelios, you're here. So what's up with that? What are we seeing?
So first of all, we talked about this yesterday. We said that market was pricing 50-50 for a cut. One of our friends actually here on the webinar said that even if they don't cut, I think the pound is not dropping. I said, look, if they don't cut, given that it was priced 50-50, the cable has to rally. But it won't if they don't cut, but it's a dovish cut. So it's a dovish hold. So they indicate that, look, it's very close to them cutting, which they didn't do. So what they did do is they said, Carney said that he acknowledged that there was an increase in economic activity from the elections onward. So it makes sense. There's more stability, political stability. So it was more clear on what's happening regarding Brexit. Is it happening or not? Now the details we don't know yet, but we do know it's happening tomorrow. So some uncertainty is being removed. PMIs starting to show some signs of recovery. Obviously, very early yet to say. So he did mention that. On the other hand, he did say that if this projected growth doesn't materialize, then interest rates will have to reflect that. So he opened the door for more cuts, even though he's not going to be there himself. That's what he said. So overall, it was they didn't cut, but it wasn't as dovish as people might have expected. So I think that's why the pound is rallying. And given what we have been told today by the Bank of England, it makes sense for the pound to rally.
All right. Well, that's and I know a lot of people are very happy to see him go. So
yes,
yeah,
indeed,
go back to Canada, please. I'm sure a lot of people are thinking that. And I appreciate your comments, Stelios. I wanted to make another observation here. So the Aussie has been under pretty big stress. The bounces have been really shallow. We're pretty divergent here. We're at 161% extension of this. Actually, you know what? Let's do this too. 161% extension of the head of the head and shoulder pattern. You could almost argue that this head and shoulder pattern is near completion, right? So depending on where you draw your neckline, well, I guess we still could, we still have further to go, but the Aussie's getting close to that level, especially with divergent relative strength. As long as stocks don't break down, the Aussie may start to bounce soon. So just keep that in mind. What I would be looking at, to really see if the Aussie is going to bounce or not, probably do something like this, like that. We got a nice little descending wedge. You could probably draw it more like this. Something to this effect. the Aussie look to me, it looks like it's going to bounce around these levels. Now, where's it going to go? Probably not too far. You know, I would think that, you know, maybe we might bounce up to, you know, 67.50 or 60. I think people are going to be really hesitant being long Aussie dollars, you know, going into this weekend, due to the due to the coronavirus. But it's something to think about if you're short Aussie dollars, you know, especially on some of these crosses. We've had an amazing move in the Euro Aussie. You guys know we had this big inverted head and shoulder pattern. I chickened out, you know, got out of it over here, but it's you know, made a hell of a move. The pound Aussie, really strong move today. You know, due to the Bank of England, we've surpassed a lot of targets. We're approaching, you know, trend highs. So, but I would point out that the Aussie may be a little oversold, so we might get a little bit of a recovery before a continuation lower, especially if the stock market starts to show, you know, any type of you know, buying from here. What I think is going to happen in the S&P, just so I'll kind of give you a heads up of what my view is in the S&P. I kind of think we're going to be doing something like this before we get to see what our next the next move is, something that looks like that. Like, you know, we're going to do some sort of consolidation here and then make the move higher or lower, probably based on what's happening with the coronavirus. That would be my assumption with the S&P. I think the S&P is completely driven by this the updates and current events in regards to the coronavirus. That's what I believe with the S&P. I do think the S&P, no matter what, is going to go down from here. Like, let me give you another example. Not like let's just short the S&P and just be done with it. I think the S&P will be forming a top from here near term, meaning that you could probably short the market and just close your eyes for a couple months, wake up and, you know, go, hey, you know, I made money. But will there be a better entry point? Will we be able to get short, maybe even up here? Because if the coronavirus does, you know, dissipate a little bit, you know, the S&P is probably going to recover. But I think you want to sell, you know, at the highs, near the 3,300 level. And the reason why I say that is because I think the coronavirus is going to have quite a negative impact economically, globally, to the point where it is going to affect global growth and in turn affect the, you know, the US based companies as a result. So because of that, I think that the risks are, even though the S&P might bounce near term, I think you got to be a seller of rallies, and that's what I'm looking to do. You know, and I was talking to my wife about this, and then I'll turn it over to you guys. I was talking to my wife about this yesterday about the coronavirus and how I feel about it. And I'm like, you know, it's probably very similar to SARS in respect to transmission, the, you know, mortality rate, yada yada yada. The unfortunate event is that it happened during a period of, it's like happening in the during Christmas time in the United States when everybody is traveling for Chinese New Year. So you have so many people that were out and about around the country and around the world for that matter, that unfortunately the death toll and who contracts it's probably going to be significantly higher by multiples than SARS. But a vaccine will be, you know, developed and it will eventually be contained. But the damage that it's going to do, you know, between now and the next, you know, 2 or 3 months on global GDP is probably going to be fairly substantial. So that's why I think that even if things subside over the next week or two, you probably want to be looking to sell risk regardless of what happens. Does that make sense, you guys? Stelio, Steve.
Yeah.
I don't know if you guys like. I don't know if you have any input there, but that's.
I totally agree with your analysis, Blake. Although I'm a little bit more skeptical that it's going to take so much time for the market to see a rebound, and the reason is because what you said is 100% justified, and makes sense, but the markets have stopped acting by what makes sense. So once the market starts seeing that the problem is on its way to being resolved, they're not going to care about how much it's going to affect this year's GDP, because they're going to keep propping it up. So I'm a little bit more skeptical about how long that might need to play out. Other than that, I agree 100% with everything else.
Yeah. All right. Well, it's just some food for thought, guys. And just so you know, I'm a little at this point in time, I'm a little skeptical about doing, like I don't want to be short equities here. I closed them this morning, and you can see S&Ps are getting a little bit of a bounce right now. I do think that we can rally going into this weekend, and like I said, the optimists in the market are going to be like, hey, things are going to get better and blah blah blah. And I think over the weekend is really going to set the pace on how stocks respond from here. But I would be very careful about being short. I think that we might do something that looks like this.
Well, Blake, the market might celebrate no witnesses in the impeachment if the vote goes that way Friday. That's the end of it.
That's true. I mean, there's there's a few things that could really that could boost the market from here. So anyway, just be careful, guys. I just I'm going to proceed over the next couple of days with caution going into the end of the month. Is the end of the month. You got some flows coming around. You got this very fluid situation with the coronavirus. So just try not to get too directional and too biased in one direction or the other ahead of the weekend, if that makes sense. After the weekend, I think we'll have a little bit more clarity on what the stock market may do. So
yeah, I'm strongly neutral, buddy.
I'm strongly neutral at this point, and it's okay being that way. But I will be here yesterday, by the way, for the daily roundup webinar. I was 15 minutes late. I did broadcast. I was 15 minutes late. Thank God Steve called me, because I lost track of time. And I'm like, because I knew, I'm like, okay, I got to get back. They have my watch on them, which is rare. I'm like, I need to get back to my desk here shortly. And then I was scrambling around doing other stuff. And Steve called me, and I heard my phone, and I picked up. He's like, you didn't start the webinar, did you? And I'm like, oh my God. So I will be there today at 12:30 Eastern to give you an update like 4 hours from now. So make sure you tune in. It's free to tune in. And in the meantime, come join our team with Forex Analytics. We have our trial where you can only pay $1 and you get 10 days of full access to all of our stuff. You can be in our chat rooms, see what we talk about all day long, and take advantage of it because you can. All right. So I'm going to pass it over to you guys.
All right, good luck today, Blake, and bring a note from your mom.
Yeah, hey, good luck, guys. Bye.
Hey,
okay,
guys.
so
hey
guys.
Hey, Phil.
So the main event today was the pound, almost a non-event, but no, we had a little bit of movement, but really not too much clarity yet going forward. I think the first Bank of England meeting under Andrew Bailey, who's going to be the new chair. Remember, he's the guy who used to be the chairman of the FCA, Financial Conduct Authority. He probably is going to give us some indication on what kind of chairman he's going to be like. So that's
love a little Baileys in my coffee, bro.
Yeah, make the coffee Irish. Yeah. So that was the main event. That's gone. We do have GDP actually, US GDP in about 10 seconds. So let's wait for that first. Do you have up the there we go.
Here it is.
Okay. 2.1 expected. 2.1 came in, so in line.
US core PC prices weaker. Everything else as expected, more or less.
Yeah.
So I assume there is not going to be any movement.
Yeah. Okay. Okay.
The quarter on quarter at 2.1. Yeah.
A dollar weakened a tad.
Yeah. GDP price index was lower than expected. I mean, it's another minor indicator, not like GDP, but still, I think overall it's a non-event. Okay, so what else is there? Well, not much more apart
You
from
tell us, Stelio.
we're we're still trying to track how this virus is going to evolve, because that's the main thing driving risk assets at the moment. It does sound a bit scary. I still think that the market's a bit complacent in terms of how how seriously it takes this threat. Although the stocks are down today again, but so far we haven't had much movement. We did have some German data today, unemployment slightly better than expected, and also CPI, I think, was exactly in line, 1.7% year on year.
You have a chance to buy Tesla, Stelio.
Man, seriously, that's
Here it is. Here's your chance, bro.
Jesus, this is parabolic. I mean,
you can either buy Tesla or buy a couple of companies like BMW.
This reminds me of the Volkswagen short squeeze. Remember that one some years ago?
Oh, yeah.
It's exactly the same, and I won't be surprised if Tesla's back below 300, within a few months. It's not going to go, in a single day, but it's just valuation is completely wrong in my opinion. Everybody's buying this growth story. I'm not exactly buying it yet, but anyway. So that's it from my side. I really don't have that much else to say. Brexit tomorrow. Big chunk of the EU leaves, big economy leaves. Let's see what kind of agreements they put in place within the next few months. By the end of the year, they have to have put stuff in place. So that's it.
Okay.
My friend.
Okay. Do we have anything else coming up today? Nothing major from what I see. Yeah.
Nothing.
Okay. Great. So I was expecting actually, if we got what we got today, I was expecting a breakout in the cable. It hasn't happened yet, although it has rebounded, 120 pips from the lows, which was a perfect opportunity to buy there because the risk reward was, amazing. It was testing once again this triangle support. So, if anybody took that trade, it was worth it. But to be honest, I'm curious to see if it can actually squeeze above the triangle to close the day. Most likely not. It's very rare to see more than 150 pips of a range nowadays in major pairs. But the case remains one way or another. Consolidation after this move higher increases the likelihood that the breakout is going to be to the upside. So against 129, as we've said again and again, I think it's looking much better being long than short. We even have the Euro USD producing, some type of a reaction from this horizontal support zone. Now, on the other hand, it hasn't completed this head and shoulders formation, which would point down to 109. So, a little bit uncertain of if it's going to do it or not. Anyhow, I'm, as I've advocated multiple times, taking a position in Euro USD makes no sense. There are much better opportunities out there, things that, look much more clear and are much more easily tradable. Euro pound, on the other hand, since we were mentioning the pound and the euro, is still getting rejected from this descending channel trend line resistance. And as long as that's the case, you have to respect the downside. So as long as we remain below 85 cents, it is what it is. The path of least resistance remains lower. Now, if we break above that, then we can talk about a possible squeeze to 87 cents. But, only if that happens. Unless that happens, keep looking lower here as well. Now, having to do with stocks, Blake already covered the S&P. I have nothing to add there. I've decreased my position a little bit just to make this this trade free of risk, and I've moved my stop loss above yesterday's high because now that we turned lower yesterday, and Dale definitely remembers that I told him that I'm not worried, that I expect the market to turn lower once again to at least retest the lows. We did that earlier today. That's actually when I decreased a little bit my exposure, and with my stop loss now above the yesterday's high, I'm not really worried about it. So it's, a risk of trade for me. If it keeps on moving to the downside, perfect. Ideally, I would want to see 3180. If not, it's okay. I mean, um, uh, regardless, I still prefer to see 3180 before high. Now, I'm much more skeptical that any type of sell-off, since it's solely for the time being based, according to market participants, on the coronavirus effect. I'm quite hesitant to say that it's going to last long, because the market has stopped caring about like GDP growth and things like that a long time ago. So once the market starts pricing in that the coronavirus issue is going to start fading, I think that it's going to go bait once again until the market starts focusing on the real big problems that hinder economic growth, and not something that is transitory as a virus. And most probably this virus threat is going to prove to be transitory once again. Now, the rest of the indices, though, for example, I want us to have a look at. For example, the DAX is attempting to break below this ascending blue channel. Just below, we find this red channel. So bottom line, if we slice through both of those, let's say roughly 13,100, that's going to be a bearish event. So I would expect that below 13,090, 13,100, there's going to be more downside here. Having to do with the FTSE, still consolidating within this larger triangle. I mean, we still have some distance until we find support. So, not much to do here until we get a solid breakout one direction or the other. The Nikkei looks somewhat more interesting, because as you see, it's back testing this breakout area again. This is like seventh time since we broke higher from this level that we're back testing it. So quite an important, this 23,000, 22,950, quite an important area of support. If we break through that as well, I would expect continuation lower. And guess what? Yeah, that most probably is also going to indicate that the USD yen will be continuing lower. I mean, if the Nikkei actually does this move, that's not good news for the USD yen. And the USD yen is not far away now from a nice confluence of supports. We have at 108.50 both this ascending trend line support and the 200 daily moving average. So 108.50 is going to prove probably very important for what happens next for the trend. And I think that's where you should be focusing if you want to be trading this currency pair. Now, just briefly back to the indices before I change the topic. This is the Australian stock index. As you see, it had briefly broken above this multi-year ascending channel. I'm curious to see if that was actually a false break or not. Obviously, the downside has been very limited, and the main reason for that, Blake already showed it, so I'm not going to focus on so much on that, is the fact that the Aussie USD is still under pressure. We said several days ago, I was monitoring this head and shoulders formation. The completion of this formation implies a retest of the low. So I'm curious to see what's going to happen from there. Definitely the fact that we falsely broke above this channel and then back below it is anyhow a bearish development. And we had since yesterday another bearish development in this complex, which is the fact that the Kiwi is also breaking down from this ascending channel and the 200 daily moving average. So, both the Kiwi and the Aussie are showing, typical bearish behavior, and that is something that you shouldn't discount. Regardless, we have absolutely no reason to disregard the downside, because the Kiwi is still in what is clearly a long-term downtrend. I mean, even this high that we found here was a little bit lower than the previous high. So, that makes it now a lower high. I mean, I was expecting that we would see another move to the upside because initially this move lower was clearly corrective in nature, and I was expecting that, as long as we remained above 65.50, we would see something like that before we could actually see lower levels. But as it proved, that never happened. So now we're threatening with this breakdown, and that's going to definitely be a bearish event, which is going to open up a lot more downside for the Kiwi. Anyhow, I said since the beginning of the week that the Aussie yen and the Kiwi yen had already broken down, and I consider those to be probably leading. The Aussie against the USD and the Kiwi against the USD, and so far that proves to be the case. So those remain under pressure, and this brings me to another question that we had about the euro and pound crosses. Obviously, with the Aussie and the Kiwi underperforming that much, the euro Aussie is threatening. Let's see how it's going to close the day, but so far it's threatening with a breakout from this rectangle, and we had already discussed about it. A close above 163.50 opens, a target that equals the height of this formation. That would imply a move towards 167.30. And Euro Kiwi is also threatening with a break back within this symmetrical triangle, which is going to be, a bad news for the bears, because initially this looked like a nice rebound. We got once, we got twice rejected from retesting the triangle, but if we actually don't get rejected once again, that's going to indicate that there is probably more upside coming here. Of course, let's wait for a few more hours, because we can again prove to be unable to move above it, but it looks like this time might be different than the previous two times we retested this broken triangle. Now, for another question that we have about USD CAD, nothing has really changed about the USD CAD. As I was saying the other day, I hope it was in the webinar and not in the chat room. I think it was in the webinar. There is not much resistance until 133. I'm looking at this larger formation, and a break above 133 is definitely going to be a very bullish development. But until that happens, the closer we get to 133, the more appealing the risk reward is going to be for short positions. In essence, to play that, to trade that, we're not going to have a breakout yet. So, for example, we are almost testing the 200 daily moving average here. If you believe that USD CAD is going to remain trapped within this triangle, you can sell a little bit here at the 200 daily moving average, and then sell a little bit higher at the 78.6, which is at 132.50, and then sell a little bit higher closer to 133. Then you can have like a cost average, let's say, of 132.50, 132.60, and that will allow you to have a stop loss of something like 60, 70 pips, and look for a move back towards the bottom of the triangle. So the risk reward is going to be very, very appealing. So these are the two ways you can actually trade this. Now, personally, I'm currently involved with other things, so I'm not so much eager to play it. But I'm just giving you the two options you have in case you actually want to trade it, or in case you have like a strong bias, in which case you know which of the two approaches you want to take. Dale, if you're here, Forex Gal is asking if there are any eclipses in the near future. So I'm definitely not the man to answer that. Steve, please, your comment on pound Kiwi. Yeah, I forgot to mention the pound pairs. So pound Aussie and pound Kiwi. So pound Aussie, once again, back above this expanding triangle. So, clearly remains well bid. I mean, we have a series of higher lows since the end of July of 2019. And as long as that's the case, it remains in an uptrend. Next upside targets, you just fib extend this last corrective move lower. That indicates that if we cross through the previous high, the next upside is at 197.60, which is the 127% extension of the last corrective move. So, it is what it is, and it remains well bid, and that's the direction of the market you want to have if you want to be trading it. Now, pound Kiwi is not as clear cut because, as you see, oppositely from the pound Aussie that has broken higher, the pound Kiwi hasn't. In fact, it's more or less in the middle of this long-term ascending channel. So I have to say that this is a much tougher one to make a decision to trade it lower or higher as we speak. Of course, there's no chance that one of them is going to be moving higher and the other one is going to be moving in the opposite direction for more than a couple of days. So, if you like pound Kiwi to the upside, pound Aussie to the upside, it means that you probably want to be trading pound Kiwi to the upside as well. But, there is no risk reward to do that yet from where we are. Okay, there was risk reward when we tested this nice confluence of supports down here. It was a horizontal support area and the 200 daily moving average, and that actually held. So that was a good entry area with a very appealing risk reward. But currently there is no such risk reward to be on the long side. Not even close. Hello, Dale. I'm Samuel from Myanmar, Asia. Okay, nice to meet you, Samuel. How should we know the virus affecting particular currency, stocks, etc.? It's a few more examples of lower frames. Define, please, lower time frames. How low time frames? I mean, some people consider lower time frames like 5 minutes and 15 minutes. So, I don't know your trading style. So please clarify. Now, there are a couple more things I wanted to show from, the less traditional ones. One of them is the USD CNH. And the reason I decided to mention it today is because I expected the previous week that we might have a rebound that was a nice confluence of supports. But now we are at the opposite side of this channel, which means that we are testing this channel resistance here. So, what happens from here, it's quite easy to determine. It's binary. I mean, we slice through that, and that will make this whole move look corrective, right? You can clearly see here that this move lower so far has, acted as a perfect correction. I mean, it's choppy, it's overlapping. It took a lot of time to go from 720 down to 685. So I think that the break higher from, let's say, a daily close above 7.1, 7.01, is going to be a bullish development. And, you make whatever you want from that. I mean, many would tell you that, USD Chinese yuan breaking to the upside is not going to be viewed favorable from the markets. And that might as well be the case. Now, the USD against the Singaporean dollar, also, if you have a look at it, has broken above this descending channel after finding, support at an important support resistance area. You can see it here. So that has already broken to the upside as well. So, I wouldn't be surprised if the USD CNH follows. That's why I wanted to show it today. Now, on other news, copper has been working on its 12th consecutive down day. I expected that this level might have provided, for a rebound before we move lower. It didn't. And, the copper is in danger of, moving much lower. Of course, nothing moves in a straight line. Already the daily RSI is at 20. So I think that it will have to take a breather sooner rather than later. But the fact that we broke below this ascending channel and we're, threatening with a breakdown from this horizontal support area is definitely.
Dr. Copper contracted coronavirus.
Yeah. I mean, it's something that you shouldn't be taking lightly. That's the only certain.
Yeah,
certainty.
between crude and copper, there's some kind of message, don't you think?
Oh yeah, absolutely. And none of those messages are positive, and the stock market doesn't seem to be listening, because the pullback in the stock market is,
Tame.
so tamed in comparison with the signals everything else is sending us. Because Dale, don't forget the most
Yeah,
important
bonds.
signal. Exactly. Look at the 10-year, which has clearly broken down. I mean, we assume that's
I
going to
think
happen.
Pinkert was all over that one.
And and the 30-year one, right? So,
Yeah,
I mean, bonds are looking like, especially the
Yeah.
30-year one. If I remember right, and correct me if I'm right, that 1.9 was
Yeah,
an
that
all-time
was-
low.
right. So the
Yeah.
10-year did not make a new all-time
No.
low. So it will.
I don't know if
I
it
can't
will,
say.
but
You don't think it will? 145?
I'm not sure it will.
Well, if we go to
but
3180 in the S&Ps, it certainly will.
oh yeah, but I can tell you one thing for sure. Bonds still seem to be trading with the full belief that the Fed can actually control the yield curve forever. Yesterday, we had, as clearly stated as possible, Powell saying outright what I had assumed they implied some time ago, this ridiculous notion. He actually used the word saying that, we're now targeting 2% inflation, which means, that's exactly what he said, that, for every day that we have below 2%, we can have a day like above 2%. So in essence, the market believes that this is the Fed setting a higher inflation target. I believe that's the wrong interpretation. I believe that's the Fed acknowledging that inflation is going to move higher and they can do nothing about it. So they would rather make it seem like that's what they want to do, because if they make it seem that's what they want to do, nobody can ask for action and corner them. Then seem that they've lost control of inflation and there is nothing they're willing or are capable of doing. So they wanted to get ahead of this and target higher inflation because they know that they're going to get higher inflation. Now, I do think that in the not so distant future, with all they've been doing, inflation is going to be a problem once again. And once you get that out of the bottle, letting the genie out of the bottle, it's not easy to tame it, especially considering the very, very high debt that we now globally have and the addiction of the economy to high asset valuations.
But
Because
can I push back a little bit?
Of
Isn't
course,
the
of
breakout
course.
in bonds, the weakness in crude and copper actually whiff of deflation?
It's a whiff of weakness.
Deflation.
Yeah, it's a whiff of weakness. I mean, economic
Okay, well, you don't
weakness.
want to call it because you're married to the word inflation now.
Don't
But,
forget.
But that's what happens during times of economic weakness. You can still have deflation. Maybe that's why they're saying that.
Usually, during economic weakness, we did have deflation. That all stopped when they started messing around with monetary policy.
Well, I'm just
Because
saying what weak copper, weak oil, bull market and bonds, those are not inflation signals to me.
Absolutely not. And as I said, all those are still signaling to a market that is reacting Pavlovian, in a Pavlovian style, to what has been happening in the near past. But don't forget that you're giving good examples here. The 70s were not that far away. We know what happened during the 70s. We know that you can actually have both a recession and inflation. We've seen that happen in the past. And I think the central banks are setting up the stage for a repeat of what we had in the 70s.
Well, then after this fifth wave in bonds and final push down in yields, if you're right, bonds are going to be the short of the decade.
That exactly is my point. That's why I'm a little bit skeptical of if we can also see a new low in the 10-year, because I don't know for how long the bonds can keep ignoring the dangers of an increase in inflation.
Long enough for us to put positions on, I believe.
Yeah, but that doesn't change the fact that we both agree, Dale, that the path of least resistance, this was clearly corrective formation. And if you're talking shorter to medium term, definitely yields should continue moving lower from here. There's no question about it.
I think this is the last hurrah.
Might as well be. Yeah, I think that this ridiculous situation with bonds can't really go on for much longer. I mean, the market will.
Kitty.
Yeah, she's she just wants to be.
See, she's taking my side.
There she is. Yeah, there she is. So let me see. What did Euroswiss? Yeah, thank you. Stagflation, weak growth, and higher inflation. 70s all over again. Yep, that can easily happen, and they're not ready for it. Let's see. Actually, I've said that before. Keep in mind that central banks don't even test for stagflation anymore during the stress tests. Now you can give two likely interpretations about that. Interpretation number one, they think it's a 0% possibility of happening ever again. Possibility number two, you don't want to stress test for something that you know they're going to fail. So, make your pick.
Anyway, for you guys that are going to be potential grooms, you now have a name for your celebration. You're going to have a stagflation party. not just a stag party, all right? You're going to.
Here is the Euroswiss that our friend is asking for. As I was saying the other day, and this is what we drew on the webinar, I would favor long positions here as long as we made it above the green line, and we got rejected from there. So, keep looking lower until we can actually break through this wedge. If we do break through this wedge, I think you can be looking for a stronger rebound. But until that happens, the next downside support is now 165.77, which is the 161.8% extension of this rebound. So it is what it is. Keep looking lower until we break through this wedge. I mean, as simple as that. And probably not a counter trend trade once we break above this 172, 173 area to attempt to catch a little bit more upside in the days that are going to follow that. Okay. How to trade when news releases? Can you please explain it? I'm against trading news releases unless you strongly believe that the market is pricing in overwhelmingly one direction or the other, in which case you might want to take the other side. So in general, I think Dale has said it in the best way. How have you said that, Dale? Those that trade the news today sell newspapers tomorrow?
Oh, yes. People who buy headlines today sell newspapers tomorrow.
Yes, I think probably that's the best way to put that. Now, having to do with palladium, what do you think is going to happen from here, Dale?
Wow. Yeah, that's really weakness.
That's really weak, right?
Yeah.
So, as you understand, I'm
back
still
under
holding...
the throwover.
Yeah. So, as you understand, I'm still holding my position here, and
that was one of the best stop picks of the month.
It looks like quite a promising formation for a continuation lower here, with the next area of support being at 2,151,160.
And that's still expensive.
And that's very expensive still, considering the vertical move we've seen. So I still believe that palladium is going to be moving lower from here. Now, I know that silver has really has really made some people miserable lately. I mean, we've had these two flash crashes. One happened, a few days ago, and the other one happened actually yesterday. But silver is still holding this formation, as gold is also still holding above this triangle. So I have to say,
They've done nothing wrong.
they've done nothing wrong yet. Yeah, I'm not very happy with momentum and everything else, and I'm pretty happy that I chose to trade palladium instead, because it has been definitely performing much better to the downside
I see you, Kirk.
than they to the upside. But I have to say that it seems dangerous to me to just blindly try to short gold and silver, because they'll put it in the best way. They haven't done something wrong yet, right? So until they start doing something wrong, don't it's probably not a wise idea.
Until I'm ready to get long US dollar yen, I'm not even considering precious metal shorts, and I'm not ready to do that yet.
That's probably a good way to put that. And last but not least, so you can start the interview, having to do with the dollar pullback today. Keep things in context. I mean, we've been rebounding within this channel. So this is a pullback and nothing to see yet here. Okay, so don't make it like a big event. It's not yet. I mean, nothing moves in a straight line, especially the DXY. We know that it has been moving in both directions in a manner that is definitely not impulsive. So don't go out there shorting or going long the dollar every time it has a hiccup or the opposite. I think you should be very, very careful with trading the dollar, and you should limit yourself in seeking shorter term targets. Thank you, Dale. Enjoy the interview.
Okay, thank you, Steve. Hi, Kirk. I'm going to get you set up now, buddy.
There. Can
Welcome
you hear
back
me?
to Face.
Yes. How are you doing?
Long time, Kirk. How have you been, buddy?
I've been very good. Happy New Year.
Happy New Year. Hope 2020 is a good one for you. And have you been in Zoom to share your screen?
Yep, I use Zoom every weekend for my stuff.
All right.
It looks like we're sharing. There you go. Now, am I sharing to you?
You are.
All right. Excellent.
Okay. So
Kirk is into oil, if I remember right.
Yeah.
Okay. So I wanted his input about what he thinks about natural gas, which is becoming again very cheap, and what he thinks crude will do during the next recession. Does he believe that dollar can weaken and hence have the dollar's effect be more strong than recession demand issues, or what? Thanks, Dale.
Okay.
Well, I have thought that through.
Okay, Kirk. So is this a new look for your website and a new name, Blue Mound Asset Management?
Okay, so Blue Mound Asset Management is my investment firm.
Okay.
And I have
a new name.
Pardon?
Is that a new name?
No. Fundamental Trends is my investment letter.
Oh, okay.
Blue Mound Asset Management is my investment firm.
What's a Blue Mound?
There's a park in Wisconsin called Blue Mound.
Okay.
And it's
pretty.
Apparently it looks blue because of all the lakes.
Oh, I see. Okay. All right, cool. All right.
So anyway,
I'm always curious how people select names.
Yeah. It's a state park in Wisconsin, and Blue Mound Road is the busiest road in Milwaukee.
Okay.
So it goes from Milwaukee all the way to Madison.
Wow.
Yeah.
Okay. Been to both places. So, every rally, Kirk, in crude, whether it's an attack on a Saudi oil facility or a little bit of action between the U.S. and Iran, which is something else you've talked about since we've known each other. crude can't seem to get out of its way. I know a lot of bears are projecting sharply lower, but the bulls are going to start contending this 50 to 52 area is going to be is actually a pretty good entry for the long side of crude. Where's your head at on the energy complex?
Well, why don't you give me 2 minutes to walk through and I will get there.
Okay, go ahead.
So the first thing, let's take a look at the big picture, which you guys have been talking about, and just an outlook for the 2020s and this year. And my outlook's a little different than a lot. I actually believe that this will end up being a down year on the S&P 500. I think there will be some contraction. In this letter, I talk about early year volatility and how at the end of the year, if President Trump looks like he's going to lose, the end of the year could look a lot like 2018. So we're starting the year with high valuations. Everybody knows this, correct? Everybody knows that most of the market is overvalued.
Yeah.
This is what 2015 looked like. You know, we had the one correction, and then it came back to almost a flat year. But then we had 2018, where early year volatility, and then it fell off a cliff before rebounding the very last week. I think that this is the most likely scenario. I think that we're probably going to see a year that's down double digits to some degree. 10 to 20% is I think pretty certain as far as certainty goes in this business. But we could see the ice crack. And what I'm seeing from market dynamics, money flow, Elliott wave, everything, Fibonacci's, is that there's probably a long way down if President Trump ends up losing. And this is not a political statement. This is just people will be scared. There will be uncertainty. The very wealthy, who are already doing it, will lock in their gains at the lower tax rates. The end of the year could be pretty rough. So keep that in mind. Right now, we're getting the coronavirus volatility. And this is something I've talked about for a couple of years, that we were eventually going to get this sort of impact from the mega cities and the breeding of diseases. If you listen to health professionals, and one of my best friends is one, contracts out to the World Health Organization, the mega cities are breeding grounds for these viruses. What happens the next time when coronavirus, which jumps from person to person very easily, is serious like SARS? What if SARS can jump from person to person easily? So if these viruses mutate together somehow, we're going to have a bigger problem down the road. So keep that in the back of your head, because someday you're going to get a headline that says, this is as serious as SARS for deadliness, and it jumps from human to human like coronavirus. That's not what this is. So I think it's important to keep in mind that this virus is not really any more serious than the flu, other than it spreads rapidly. So in any case, that's your short-term volatility. And then at the end of the year, we might have, President Trump losing. And at the very end, just because I mentioned President Trump, I've got a trade for your more aggressive people at the very end today.
Okay, so I know a lot of people and attribute a lot of this bull run. Actually, it's called the Trump rally, and people that are very good market tacticians like Kip Herriage and so forth attributes it to it. So it has me thinking, if he loses, and I'm certainly not sure about that outcome, that we could retrace the whole Trump rally. You'd have to go back to November of 2016 and see where the S&P was, and if he doesn't get in office, should be able to take away that whole rally. Have you thought of that?
So in my last couple of webinars, I do a webinar every Friday, I have suggested that we could wipe out the entire Trump rally. I don't think we'll quite do it.
Well, where did it start again? Around 1700 S&P, 1800?
No, like 2600, something like
2600.
Yeah.
Okay.
So we'll see. I think the bottom of the S&P 500, short of a financial crisis, 22 to 2400 on the S&P 500.
Mm-hmm. Okay.
I don't think we're going to see that. but we might, it's clearly within the realm of possibility.
Yeah, I've seen some Elliott wave counts that we're ending a big wave 3 here. And we could go back to where 4 started, about 2100, and then blow to new highs.
Right. If you do the 5-year chart, I mean, clearly you're right in here, that line, that's about where you get to, right?
Yeah.
About 2200, and maybe here.
Okay.
That's this point right here is the bottom for 2018.
Okay.
And I don't think anybody should discount that we can see that level again.
Okay.
So we will
All
go
right.
back to that chart in a minute.
Okay.
So we've talked about oil a lot.
Yeah.
And I'm surprised at this point that there hasn't been a broader conflict with Iran. President Trump has really tried to avoid that as much as he can. We'll see what Saudi Arabia has to say about this going into the election, because this might be Saudi Arabia's last chance to confront Iran. If a
Why?
Democrat comes into office.
Oh, I see. Okay.
Yeah. So Saudi Arabia might force the issue. I don't know if they have the power to do that. But clearly they want higher oil prices because they're seeing something that I'm seeing. And in this article here, I went through all the reasons why oil stocks and oil got priced for Armageddon. There's a number of reasons. The long term is that oil demand eventually is going to fall off a cliff. I don't think that will happen for about another decade. But I was
because of EVs.
Because of EVs.
Okay.
Right here.
Mm-hmm.
So I went to CES this year, Consumer Electronics Show, and I will tell you, there's going to be a huge bifurcation in the economy over the next decade. The 5G, IoT, AI systems that are coming are going to hit everything. We're already seeing it in, say, oil drilling. But the EVs, which are basically an IoT device, everybody is starting to mass produce these. GM, Ford, Toyota, Volkswagen, you go right down the list, they all have plans to basically phase out their ICE sedans by the end of the decade. So there really won't be the option in 10 years to even buy an internal combustion engine car, unless you're buying luxury or sports car, but that'll be a very small market. There'll still be trucks available, but even the trucks, the smaller trucks in particular, are going SUV or hybrid. Take a look at the F-150. That's going to be a hybrid. So, and that's the most popular truck in America. I talked to a lot of executives in the parts and car industries, one of them being from Delphi, which just got bought or merged, whatever you want to call it. There is no way, there is no technology that helps the car companies get to the 54 miles per gallon average for internal combustion engines. They have to go EV and hybrid. They all said the same thing. Even if Trump is able to water down those requirements a little bit by April, which is what they're targeting, it still wouldn't be enough for them to change what they've already committed to doing, what they've already deployed capital to. Could it delay the timeline by a year or two? For sure. But the EV revolution has started. There is no doubt that it's going to take hold. And by, I'd say, by about 2030, you're going to see oil demand drop. So when does the market start factoring that in? I think the market's already factoring that in, right? Oil's been weak for 4 or 5 years. It had the one rally in between, and I don't see any of that changing. So what we know is that what I have called for about, I think 2014 is when I first said this back on Market Watch. I call it the peak oil plateau. That's what the 2020s are. A rough balance between supply and demand until demand really flattens out, maybe by the middle of the decade, and countries that have oil look at this and go, oh my God, I have to sell this oil. We have to sell this oil before nobody wants it. So we're probably seeing huge downside in the price of oil I don't know if it's going to be Tony Seba low, but within the decade, you probably see oil at $40 a barrel pretty consistently, 40 something a barrel pretty consistently in the shorter term. In the shorter term, we take a look at oil and we have to ask some questions. What is going to happen for the next year? Because that's really what everybody's concerned about, right? Nobody's looking 4, 5, 6, 7, 8 years out, but let's just look at the whole thing in context. In the next year, what is oil going to do? If we get what I have termed a skip straight recession, and that is a bad quarter somewhere in here. I don't think that we're really lined up for recession. None of the indicators say that. But let's suppose we have a 1% quarter, 1% GDP quarter. I think that's very likely. That probably pushes the price of oil down again. I think you could see it touch somewhere in the low to middle 40s for a hot minute. I think that's a very difficult trade to make. But if you can get the pricing on your securities, right, it might be worth putting a couple percent in because the upside might be gigantic. The only thing that really drives the price of oil up in my mind past 80, and I don't even know that that's even possible anymore. And this sounds a lot different than me a few years ago, right? I thought for sure the executives in the oil patch would control the production of oil. But they must all know, A, how they get paid, right? They get paid in a way that's not conducive to the shareholders. And B, they must know that the oil age is coming to an end. And 10 years from now, they don't care about. They care about getting paid today. How much can the executives suck out of these oil companies? And that makes oil a very difficult investment. So the long-term trend is down. There might be a pop-up for two reasons. The only two reasons would be if the economy heats up in the short term, which I don't think is very likely, or that conflict in the Middle East that I talked about is there. So I don't think that there's a lot of upside in oil in the short term. By about 2021, 22, 23, right in there, you probably get that last oil rally. But I think you should probably ask yourself the question, if I'm a stock investor, why, if the price of energy goes up, why wouldn't I just be in alternative energy? Because
so I have an important question. I know we're looking forward, but you brought it up. So your narrative in oil didn't pan out as you had thought. How did you manage your positions, and when did you know that it wasn't panning out, and did you suffer drawdowns because of it?
Oh yeah, I got my ass kicked.
Okay, there's transparency.
Yeah, I mean the reality is that if you were in oil the way I was, you couldn't avoid 20 and 30% drawdowns. So on those positions, you took a look at what ended up being the worst oil bear market in history.
The caveat being, before we turned lower, you made some great calls in some natural gas stocks and some energy stocks that were promising. In fact, one looks like it doubled. Do you know the one I'm talking about, Kirk? It was a natural gas stock. You said it was really almost like buying an option.
Well, we made the trade in Chesapeake Energy.
That's it. Yeah. Okay.
Yeah, and that's trading at an all-time low right now.
Right. But when you liked it, there was a huge move to the upside, almost a double in price or something like that.
Right. It almost tells you that I should trade more often and invest less often.
I think we're in that climate.
I do. And so one of the things that I talk about in here and in some of my webinars over on YouTube is that I think the 2020s are going to be a lot like the period from 2000 to 2009. Wow. If you're a trader for the next 10 years, you know who you're going to be taking money from? You're going to be taking money from the indexers. So all of these people in the FIRE movement and everybody else who has just moved away from active management, there's going to be a transfer of wealth from the investors to the traders. And I'm a position trader, so I'm not looking at, day to day or week to week. I'm looking at quarter to quarter and annually, or 2-year periods even. But the trading approach that you're going to take if you want to go all the way back, I mean, I think there's a lot of people who don't know what this time period is right here, right? So if you take a look at, you guys turned me on to a trading view. I still haven't learned how to use it as good as I could. But this period
Okay,
here,
so we had the peak in 2000, and then we had a peak in 2008.
right? So this is what people should be thinking about,
Ranges.
right? That's this decade, right? The newer decade is not going to be. We're not going to get another 2010 to 2019. It's not going to happen. So what we have to consider is, will things look like this? And I think they will. So are you better off being a buy and holder here? Are you better off saying, okay, overvalued, I want to sell, undervalued, I want to buy, overvalued, I want to sell. And in between here, what kind of moves can I make? How do I manage risk? Using whatever trading technique you're using. And I just think that you are in, I watch your video from time to time, and I don't have time every day just because I do other things, and I'm not a swing trader, but I think that you're in the right spot, which tells me I probably ought to swing trade just a little bit more often. So with that in mind, I have some trades that you can make if you're interested in oil.
Okay. Someone's asking if you would go over, Jess is asking if you could go over in Canna. Was that one of your selections?
In Canna, yes. So
Yeah, okay.
that is my fourth one.
Okay.
So we will get there. So let's take a look at the oil patch. If we're in an environment where oil is challenged forever now, right, with just a handful of rallies, who do we want to be invested in? I would argue that the only oil companies to be invested in at this point are companies in the Permian Basin, either largely or their Permian pure plays. Why is that? Not only do they have the cheapest oil, easiest oil to get, it's easy for them to get it to the Gulf Coast now because there's new pipelines that have just come online and more that'll be coming on in the next 18 months. And not only oil pipelines, but natural gas pipelines. This is one reason why natural gas is going to be perpetually depressed. There will be rallies that you can trade, but in general, natural gas is going to be perpetually depressed because there's a lot of new supply coming on from the Permian Basin.
So to answer Steve's question, although it's cheap, it could remain that way for quite some time.
It's already been cheap for how long? 7 or 8 years?
Yeah. You get intermittent weather rallies.
Exactly.
Okay.
And if something blows up somewhere.
Okay.
But those are really the only things that I see that can drive oil and gas higher temporarily would be disruptions. How do you forecast a disruption? It's very difficult. So
impossible.
Yeah. So I mean, you can react to the news faster than the crowd sometimes, but in general, forecasting it is going to be very, very difficult. So if you're a longer term investor, trader, I would say oil and gas are probably not the place for you. Now, if you're a trader, volatility is a wonderful thing, right? So, you can use whatever system, Elliott Wave, Fibonacci's, just basic technicals. I use money flow quite a bit. You can figure out what you want to do. Probably the best oil company in America is Pioneer Natural Resources. Why do I say that? Permian pure play, very conservative balance sheet, and they're about to start getting something for the natural gas that they haven't gotten anything for. So this is something the market doesn't price in, is they have a whole new source of revenue because they can sell their natural gas. Granted, it's not a great price, but it's better than zero. So Pioneer clearly has downside to around 120. You could take a look at just where it keeps getting institutional support. So from 138 down to 120 is probably your downside. And I think it can get close to setting an all-time high, but I don't think it's ever going to break out. I think that this is a very strong resistance level up here. So your downside.
So you have a range like you were showing in the previous chart. Trade the range.
Exactly.
Got it.
I don't think any of the oil and gas companies ever set new highs. I think that day and age is over. I think that if you're looking for a breakout above their all-time highs, you don't understand what is going on in history, which is this.
Yeah.
Right. The EVs will dominate new car sales by the end of the decade.
Okay.
So Pioneer probably being the best company out there in the oil patch. People talk about the oil majors being a good place. They're wrong. You see what just happened to Royal Dutch Shell today, and they're largely natural gas. Exxon, Chevron, you go BP, they're all going to get crushed. They have huge legacy expenses. They're never going to be able to monetize all their assets. And who's going to buy them? There's nobody they can sell their assets to. Even governments won't buy those assets. So eventually you're going to see Chevron, Exxon, and BP all broken up. And there will be one piece or two pieces, usually the real estate pieces, that'll be worth something. But
what's that say for the Saudi Aramco IPO?
It's a worthless asset.
Okay. I knew you'd be candid. Okay, so
think about private equity. When does private equity take things public in IPOs?
When they don't want it, but when they need bag holders.
Exactly. It's exactly what's going on.
Well, you and I are too jaded.
Mr. Wonderful goes on CNBC and he says he wants to buy the Saudi Aramco IPO. You can say, hey, that's a big mistake that guy is making. He's right about almost everything. I mean, he's a smart dude, but none of the oil majors have long-term futures. And when you take a look at, they talk about expanding petrochemicals. Baloney. It's not going to happen. There's already technology to replace petrochemicals that petrochemical companies aren't investing in because they know that's the replacement. There's a little company in California called New Light Technology that can suck methane and carbon dioxide out of the air and using super old technology that they brought the cost down 95%. It's 100-year-old technology, and they just had to make it cheap. This guy made it cheap, Stanford guy, and now they can turn it into plastic. Coca-Cola and IKEA are already using it. If Coke and IKEA are using it, it's coming. So, there is no hope for the oil and gas companies long term. There's only a chance for some rallies on disruptions. And for a very short period of time in the early 2020s, you could see a slight imbalance between supply and demand to the bullish side, but probably not for very long.
If the Straits of Hormuz are choked.
Yeah, something like that, or
okay,
Saudi Arabia and Iran blow up each other's, biggest refineries.
Okay.
So your downside on Pioneers to about 120. Your upside is to about 200. I don't even think you get there. Some sort of Fibonacci retrace into this area, but you should be thinking exit strategies if you're in any of these. But this is the best one, and I don't sound hugely bullish, do I?
No. But best of breed.
Right. So Parsley might have the most upside. They just did a merger. They're a Permian pure play. They are clearly a company that Chevron, in particular Chevron, could buy. In fact, I would speculate that by the end of this year, Parsley Energy is owned by Chevron. So at these prices, I think you have upside into the middle 20s, which is a 50% move. If you're using options, that could be a lot of money.
Liquidity in those options?
Pardon?
Liquidity in those options?
They're just enough.
Okay.
Right, just enough. And
do you ever look for like size coming in to tell you you're not the only one with this idea?
Right. Well, that hasn't happened yet.
Okay.
There's only a handful of people who've had the guts to do it so far.
Okay.
So you're getting decent pricing. But you need to keep an eye on the news because we don't know, right? Because options get expensive with more time value.
So it'll be probably too late if you waited for the two ponytail guys on CNBC to tell you there was unusual option activity.
Exactly. You kind of want to be the unusual options activity.
Right. Okay. Got it.
But at these prices, look at this support. That's pretty strong support every time it gets down here. I think that if you want to start scaling into some calls here over the next couple of months, go ahead. But I'd be looking to roll. I wouldn't be looking to buy a lot of time value, just because time value in this market is expensive. And I can tell you why it's expensive. I went to the Money Show a year ago out in New York, and there were some of the best fundamental analysts in the world there that couldn't fill up rooms with 30 people. But if you were talking about futures or options or day trading or cryptocurrency, you filled up an auditorium. So there's all sorts of amateurs who have come into this market. And I'll tell you, I pay attention to a lot of different groups that do similar things that you do. You've got one of the best groups and one of the best presentations and one of the most educated groups out there.
Wow.
And I say that in all seriousness. I kind of want an affiliate agreement. But I'm serious about that too. There's other groups out there, hundreds of them, thousands of them, and they're just horrible at what they do. So, I think you have a huge advantage, not only against all the millennial traders that have come in who don't take the time to actually learn. They're just trying to follow along and they screw up all the time. But, the more educated traders like your group, I think you're going to kill it in the next decade. I really do. I kind of think I'm going to trade a little bit more. I think you've convinced me.
From your lips, bro.
Well,
you know what? Your first step today is to subscribe.
Do I get a discount?
Yeah.
Oh, sweet. Okay, I'm in.
All right. Okay, so all right, so we'll look at a couple more because we're kind of at the. I don't want to rush you or anything, but
two couple minutes. All right, so started with the most conservative one. Yeah. I think that this is the best Permian pure play, Parsley. Occidental is a battleground stock. I think they get a rally because they pay the fat dividend, and if they keep shedding assets, they're going to do all right. Now, that's something for a long-term investor. You got to make sure that they shed the assets, but they should probably get a pop up into this 60-something range right up here.
Okay.
And then Encana, which is now Inventive, they just re-domiciled to the United States. They did a reverse split, so they're getting crushed. Excuse me, the coffee's not holding. They're getting crushed. This company, by book value and by profitability and everything, is worth a lot more. It's probably actually worth way up here. I think that if you're a swing trader and you're looking for something that you can hold a few months, I would be looking at this over and over and over again.
I like the divergence setting up there on your RSI. We're not confirming at new lows, so all you need is one good green candle on a weekly basis and you got something there.
Right. And I'll tell you, they have assets in Canada that I think they're going to sell. They have two fields up in Canada. I think they sell those. They have Permian assets, and then they have Oklahoma Stack Scoop. Those are their four big asset plays. It would not surprise me for them to sell everything except their Permian assets and then sell those too. This company is going to basically sell off its parts or sell the whole thing. Royal Dutch Shell was a big suitor for them. We'll see what goes down, but these guys are worth a lot more because even in the end of the oil age, right? Even with the end of the oil age, where's my chart? Even with the end of the oil age, you have a decade of making money. And even this looks so precipitous. It's still going to be by 2040, we're still using 80, 90 million barrels a day. So, because those cars last a while, people aren't just going to throw out their cars.
No, I just got one a year ago.
Right. So
it's not a hybrid either.
Right. So while this looks like it falls off a cliff, I was just extending the EIA chart.
Will all internal engine combustible cars become collector's items?
I think
by 2040.
I'm not a guy that would collect cars, but if I were, I would go buy the new Corvettes.
Okay.
And put them in storage so that in 20 years they're mint.
All right.
Okay. Those new Corvettes are going to be I mean, old Corvettes are cool too, right? Or
Yeah.
old sports cars. You know, if
Yeah.
you can go find a James Bond car, didn't one just sell for $700,000?
Yeah.
You know, my uncle's got one. So,
Wow.
you
Yeah.
know, we'll see. You know, I'm not a car collector, but I would think that the hottest cars from 30, 40 years ago, and then
Yeah.
the very last generations are going to be the collector's
They'll
items.
be worth $1 million, but who knows what the dollar will be worth.
Right.
It'll be called the American peso. So, all right. So, some nice little things for us to monitor.
Right.
And I think there's a play
Yep.
coming up here.
So I'm going to give you.
I mean, don't you think that if there is going to be a conflict, and not only because it would be Saudi Arabia's last chance if Trump doesn't win, but what a great time to have some type of conflict where the whole country is going to have to get behind the president if there is one. And we are getting reports of injuries to U.S. servicemen that initially we didn't get. No one got hurt.
Right.
And
trauma.
also, a lot about Iran. You've studied the country. They have a very long memory. And do you really think, Kirk, that just that one strike is it for taking out one of their national heroes?
No, and I'm glad you brought that up. I think that Iran is waiting for the right moment for another attack.
Okay.
I think in my mind that's clear.
Sleeper cells?
I don't know if
In
it'll
the
be on
US?
U.S. soil, but
Okay.
I would think that at minimum they attack Saudi Arabia.
Okay. All right. So, I mean, and isn't it, there's so many big things going on everywhere that what we're talking about right now, which was only a month ago, seems like it happened a year ago. We're
Right.
so desensitized to all these things that 10 years ago might happen every other year or quarter that are coming at us every day now that it's old news. People are thinking that what happened with Iran, it's over. I don't believe it.
Right.
Okay.
So that's why I take my grandmother to bridge every Thursday, and that's her calling to make sure.
Well, you know what? Why don't you just go to where people could subscribe to you and follow you and talk to you? Give them some contact information.
Do we have one more minute to give you
go ahead.
an idea?
Okay, sure. I just didn't want you to hang up Grandma.
No. She knows.
All right.
She gets. It's always 2 calls, so she knows to call me back. She knows that I'll call her back if she rings twice.
Okay.
All right. So we talked about the Trump rally, right? And that we could give it almost all back.
Okay.
We talked earlier about what if President Trump loses? I don't even know what that is. So this is a longer term chart. I have good information on this, and people who are political are not going to want to hear it if they're on the other side of the fence. You know that hedge funds and big family offices do their own private polling data, right?
Yeah.
Something reminded me to check on this, and it was earlier this year than I thought. Back in April, Stanley Druckenmiller talked about the private polling that he does. And he only mentioned it once to the Economics Club of New York. And he said, look, my private polling data is that Trump doesn't stand a chance to win. So, and he didn't elaborate. So I checked on it. I called some of my buddies in Stanford and New York, one guy in the Caribbean. I said, here, what does this mean? And they explained it to me. There's at least 3 that I know of, and I'm sure there's more, private polling data that suggests about 10% of Republicans are going to sit on their vote, meaning that these are the people that only voted for Trump because they hated Hillary Clinton. They don't like President Trump now, and they wouldn't vote for Bernie Sanders, and they probably wouldn't vote for Elizabeth Warren, but they're saying that they might vote for Joe Biden. So that's at least 10% of Republicans, give or take, and now they just had the blow up with the evangelicals, which is important to Trump. There's probably about 10% of votes out there that Trump's not going to get again. And now, does he pick up a couple percent other places? Sure. But from 63 million down to 50-something million, 57, 58 million votes, he wouldn't have a chance against Hillary Clinton. Now, here's a scenario that I think is probably going to play out. He's going to get less than 60 million votes, and the Democrats are going to have record turnout, which means that they get more than 66 million votes. So not only are you going to see President Trump lose, not by a little, but by a lot, is either going to be bad or really bad. But the down ticket is going to be affected significantly as well, to the point where you might have people like Mitch McConnell lose. So you need to keep an eye on that. At the end of the year, you probably see that sell-off like 2018. But at what point can you make a trade based on the presidential election? I think it's coming up. I think it's before Super Tuesday is probably when you get your best impact. So if we get a little bit of stock market rally between now
When
and
is Super Tuesday?
pardon?
When is Super Tuesday?
March. I'd have to look. Middle of March, early to middle of
Around
March.
the
March
okay,
10th.
so around the equinox.
Yeah,
Right
around March
spring.
10th.
Okay.
I would keep an eye on that.
Mhm.
Now, you and I both know that there's pretty big support in the S&P 500, just a little bit below 300.
Right.
I don't think we're going to fall down to 300-ish just yet, but we might. This coronavirus could have more bad news. And here's the big trade I was mentioning. It wasn't even the end of the year one. For your super aggressive people, you might want to buy more puts on the S&P 500 today or tomorrow, because the debate about calling witnesses in the impeachment is right around the corner. It's it's in the
Right.
next few
Friday.
weeks, if they get to it. But
Yeah.
if they call more witnesses, and right now it's a coin flip if they do, but I actually think it's going more in the direction of calling more witnesses, because there's 4 retiring senators.
Yeah.
And they
That's
probably
all they
all
need.
vote for more witnesses.
Yeah.
On top of the 3 that already said they probably will. So that's enough to call more witnesses. I'm going to tell you something. The odds of impeachment go from almost 0 to a coin flip, and that's going to be disconcerting to the market if they have more witnesses. So it doesn't matter whether or not he would get removed from office. It matters this uncertainty that gets introduced.
Right. That's
In
not
which
priced
case-
in. Right.
Yeah, in which case we go to 300 on the S&P.
Interesting.
So super short-term calls you can get from, puts you can get for almost nothing, right?
Yeah.
And if they hit, you make a lot of money.
Yeah.
So I
Okay,
would keep that in mind. This could break down further fast.
Yeah. 3,200 seems to be a line in the sand on the futures.
And then
So
it goes
we'll
all
see.
the way down to like 298 or something.
Yeah. Well, Kirk, let's not let this much time pass in between. And I really respect when I asked you the question about how you handled a scenario not working out for you, that you weren't a revisionist. And that's why if you want to follow someone, follow people that everyone has drawdowns, but don't follow anyone who says they never do. And Kirk has a great eye. I've seen a lot of things that he's called work. So how do people follow you, Kirk, besides on Twitter at Kirk Spano?
Right. Well, and keep this in mind. And I have a big series on 5G and IoT and AI. It'll be a major theme. There's a huge bifurcation coming in the economy. The old economy is going to get weaker. The new economy is going to get stronger. There's going to be certain things that people think are new economy that aren't. Like cryptocurrency is not going to take off anymore, and weed is not going to take off anymore. Whatever. There's a lot to be talked about there. But if you're going to trade this, right, buy the disruptors, sell the disrupted, and there are a lot of commodities. You guys, I just want to throw out palladium for you. Palladium is about to enter a massive bear market.
Oh yeah, Steve Volge's on top of that one. He shorted the top. That's interesting. Okay,
Yeah,
go ahead.
That's a great move right there. So just keep shorting the heck out of palladium, because it's going to go down to all-time lows.
Wow.
It'll take some years, but it's going to happen.
Wow. Okay.
All right. You know why, right?
Because they're not going to need it for catalytic converters.
Exactly.
Okay. Well, Kirk, again, Have a great 2020. It's January. Let's get back together in March,
Okay.
and we'll even schedule something. Hit me up, DM me on Twitter, and we'll set something up for March.
All right. You
'Cause
take care.
you brought a lot of stuff up, and I appreciate your endorsement of what we do here, because what we're trying to do every day is build up and edify traders. So thank you for acknowledging that, and it's great talking to you, bro.
Yep. You take care, Dale. You guys are one of the best.
Okay, so my Trading Warrior brother, Kirk Spano, follow Kirk, subscribe. He's a veteran, he has a good eye, and above that, he's ethical. So I'll talk to everyone later. Remember, don't just count your pips, count your blessings. And I'll talk to you a little bit later. We'll see you tomorrow to wrap up the week. And I just saw an interesting chat here. I'm curious, who is my relative, Kevin, that is a mind-boggling good FX trader, because I want to get into his hedge fund. So why don't you send me, let me know who that is, and send an email to Forex Analytics. All right, everyone, have a great day. Adios. Thanks again, Kirk.
Take care.